Hey, good morning. Glad you guys are here today. We're finishing up chapter 3 today. And I was mentioning earlier before I hit the recording that we'll have a review session in class on Wednesday. I don't anticipate holding class for the full amount of time, but I'll come up with an outline for the exam. I'm going to create a new exam today, so I'll be able to give you a better outline. So Wednesday, you'll come for that review session if you want to. It'll be available as always as a recording as well. And then next week, I will not physically see you in class because next week, Monday is a holiday. It's Labor Day, I believe. And then Wednesday is your exam, and we don't come to class on exam days. So Julie, you don't have to come to class on exam days either. So if you guys don't have any questions, I'm going to share my screen, jump in and get started. And of course, you guys are able to interrupt me anytime with questions. I don't like calling it interruptions. That's why we're here. So,
Professor, can I make a quick announcement real fast?
Sir.
Alrighty. So the accounting club is going to have its first meeting on September 7th, which is next week on a Tuesday. And the meeting is from 11 to 12 a.m. to p.m. So 11 a.m. to 12 p.m. And we will be discussing the goals of the club and what to expect out of attending the club. And in the chat, I will put a link to the link tree where you can find the Zoom link for the meetings and all the information pertaining to the accounting club. Just wanted to make that announcement before you moved on.
Okay, and Thamir, if you have any kind of a handout or anything I can distribute to my classes, I'll send it to all my classes because the accounting club opens doors that many people never thought of. And so any kind of information you can give me to send out to all my classes, I'll be happy to do that. Okay,
Sounds good. Yeah.
Okay, let me share my screen. Let's go back and take a look at our schedule that you should see on the screen now. So what we were talking about today, we're going to wrap up chapter 3 today. We're going to look at the adjustments one more time. We'll talk about the effect those adjustments have on the accounting equation. We'll look at our agenda in a minute. We'll take a look at financial statements. We'll review closing entries. And then there's a couple of ratios out of this chapter, which should already be in your toolbox, but we'll go over those. Wednesday, I don't anticipate that being a full class period. I will pass you guys out a review sheet as soon as I create it. I was telling the other students today that I'm going to make that exam up today. So I'll be able to give you a better outline of what to expect on it. And then, as I just mentioned earlier, next week, I will not physically see you because Monday is a holiday. No one comes to campus that day. Nobody has lectures. And then Wednesday is your first exam. It will be proctored via Proctorio. The Proctorio application is in McGraw-Hill. So you'll go, just like you always go, to your assignments in the McGraw-Hill tab. It will help you download a McGraw-Hill Chrome extension that's required for Proctorio. Before you take the test, I would encourage you guys to review the syllabus for the Proctorio requirements. In a nutshell, it requires that you have a web camera and a strong internet connection. By now, if you're lacking either one of those, you should have asked the campus to help you with those resources. So if you are still lacking one of those, if your computer doesn't have a webcam, or if you have a shady internet connection, or shoddy, I should say, shoddy internet connection, those items are available free to you to borrow from the campus for the entire semester. The information's in the introductory link in Canvas. Don't wait until the last second and then catch yourself off guard. So that's what's ahead. Any questions on the calendar? Okay, here's our agenda for today. So again, we're going to start off by taking one more look at adjusting entries. We'll make sure that we have a good understanding of the effects that has on the accounting equation. We know by now that all adjustments affect an income statement and a balance sheet account. And so if you miss one or you omit one, all three financial statements are affected. And that's why adjustments are so important. We will do an exercise where we show the effect on the financial statements and the accounting equation. We'll take a look at the 3 financial statements, which you guys are expected to be able to prepare on the test. That'll be the income statement, the new statement of retained earnings, and the balance sheet. You guys have had a whole semester of doing an income statement and balance sheet, so the new one will be the statement of retained earnings. We'll look at an exercise today that will kind of pull everything together. It's the one problem that we have scheduled to look at today. And then your author sprinkles ratios throughout the chapters because you guys have a whole chapter in 102 on ratios. The 2 that we'll look at today are the profit margin and the current ratios, and those are already in your toolbox from Accounting 100. So that's where we're headed today. Any questions on the calendar that I just put up? Questions on what's ahead on the exam, or questions on the agenda, what we're covering today? Okay, PowerPoint. I'm not a big PowerPoint fan, but I am going to use one to kind of recap where we've been. I'm going to pop this up from the current slide. I'm going to go through these rather fast. And remember, I only selected particular slides to show you in class today. You guys, if you are visual learners, I would encourage you to use the PowerPoints as a way to review. You have all the PowerPoints in the modules link. I've just selected a couple today. So we're talking about accounting periods, and whether the accounting period is for 1 month, whether it's for a quarter, semi-annually, for an entire fiscal year, whenever that cutoff date comes about, GAAP says we need to use the matching principle to match revenues and expenses in the same period. That's what the adjustment process is about. We learned about 2 bases of accounting. One is GAAP acceptable, one is not. We've been using in Accounting 100 and 101, we've been using the accrual basis of accounting, which basically in a nutshell says revenues are recorded when earned. And for our purposes right now, that's either when we have performed a good or service, or when products are shipped out based on the shipping terms. And we record expenses when incurred. I do remember there being a quiz question or a multiple choice question on the test that uses the cash basis. So we want you to know what it is. We want you to know that small mom and pops sometimes will use the cash basis because they don't know any better. And the cash basis says revenues are recorded when cash is received, so when cash is taken in, and expenses are recorded when paid. The book gives you a really good example of using like a prepaid insurance, I think it is. And if I were to pay a year's worth of insurance today, GAAP says under the accrual basis of accounting, you recognize the expense when the expense has been incurred. I would not recognize all 12 months as an expense under the accrual basis, but under the cash basis, I would recognize all of the insurance expense in the 1 month where I'm prepaying it. It's not GAAP, but it is out there, and we expect you to know the difference between the 2. Any questions on that? Okay, here's the 2 principles we're following in this chapter. The revenue recognition principle requires that revenues be recorded when earned. And the expense recognition principle, which falls under that matching concept, says that expenses need to be recorded in this period in which the related revenue has been incurred. We call it the matching principle. So there's 2 definitions you should probably get into your notes: the revenue recognition principle and the expense recognition principle. The author describes it both in chapter 1 and it comes back again in chapter 3. So that's some new vocabulary. Somebody sent me a really good email over the weekend. They said, should I be writing down all the definitions on cards? You know, I told you that I use cards to study. Not all of them, but I would go through the glossary of terms. And if there are new ones that you're not familiar with, I would consider writing those on cards. We talked about the framework for the adjustments. Your author goes through 3 steps. We do the same thing, maybe not explicitly each time, but mechanically that's what we're doing. We're looking at what the current account balance is. We decide what the balance should be. and we make an adjustment for that amount. I would add a fourth step for you guys because the vocabulary is new. Every time I do an adjustment, I would ask myself, how would I classify that adjustment? And we learned four classifications. We learned about deferrals and we learned about accruals. And so an adjustment, if the cash has changed hands, it's a deferral. And examples of that are the supplies expense, the depreciation expense, the prepaids. All of those have assets purchased ahead of time, and we're deferring recognizing the related expense until the item has been used up. So be familiar with the terminology. I would add that fourth step every time you do an adjustment. Questions on that? Okay, and then I'm going to go quickly through these because we've been practicing these. Prepaids are always deferrals because the cash has changed hands. And we'll go through a few more examples today on how to do those adjustments. We know how to do the supplies adjustments. We've been practicing it now for 2 semesters. That's an example of a deferred expense. We learned that depreciation is the way that we take the cost of an asset and we spread it out little by little over its life. That's also a deferred expense because the asset's on the books when we purchase it, and then we recognize the expense using one of 20 different methods. We're going to learn 4 of them in chapter 8. Right now, we know how to use straight line. So there's the formula. If you're not sure of that formula, that would be something I would write down on a card until I had it memorized. And there's the adjustment. We also need to know how to show accumulated depreciation on the balance sheet as well. I think there might be a slide on that. And there it is. From now on, when we create financial statements, we want to make sure, whoops, let me go back to that adjustment. We want to make sure that we show 3 things on the balance sheet. We show the cost. GAAP requires you to show that cost. You show the accumulated depreciation. Then right next to it, typically, you show that book value. So if that term book value is a new term for you, you might want to write that down. And GAAP gives you a couple of choices. You can show it on the face of the balance sheet, like you see on the left, or you can record it net, which means you show the cost less the book value. You can include the details in a financial footnote. Okay, so that may be a little new for you. There's also deferred revenue. The example, we've done this in class, is if I get a retainer up front before I provide my services. Accountants have retainers, attorneys have retainers. Sometimes doctors will require that you pay a chunk up front before you have a procedure. That's deferred revenue. Again, why? Because the cash has changed hands. And so our job in the adjustment is to take the money out of the unearned revenue, which is a liability account, and put it into a regular old revenue. I would say out of all the adjustments we're doing, that one is most often missed. And I think it's because of lack of understanding as to what that unearned revenue is. It's a liability account. It's a liability account because, and I probably told you in my Accounting 100 class, we had hired the services of an attorney and paid, I can't remember now, I think it was $3,000 or $4,000 in a retainer to have him do some legal work for us, and he died, right? And so that was a liability to him or to his estate. He had to give the money back to the clients that have given him a retainer. And so that's why that is a liability. If for some reason you don't complete the work, you legally owe the money back. And in class, we said, this is the flip side of a prepaid, right? For that, for me, for the person who is paying the legal fee up front, that's a prepaid. I paid him money ahead of when the work was done. For the attorney, that was a deferred revenue because he received the money ahead of when he provided the service. So I want to make sure that you guys have clarity in those definitions. Let me stop for a second and see if anybody has a question on that. Okay, so there's an example of that one we just talked about. This would be when someone has earned money that's already received it up front. Here's whoops, let me go back. Here's the adjustment for that. Okay, you'll see that today as well. Accrued expenses are costs that we've incurred, but that haven't yet been paid yet. The most common one, and a few people got stuck on the homework with this, is the wages. Always at the cutoff date, there's gonna be some wages that have been incurred, but have not yet been paid. Not only are there wages, but as you saw in Accounting 100, there's also the related taxes that go hand in hand with that. And so the way we put that on the books is we debited the wages expense and we credited the wages payable. That's an accrual because no cash has changed hands. Okay, so again, some definitions. There's an example. We had an example in class, and I think Thamir and myself talked about how the wording was kind of confusing for that one. The author told you about an amount per day, and it almost looked, I think it was like to the mirror, that it was per employee. So you got to be really careful when you guys read those questions. In this case, the fiscal year ended on a Wednesday, so they had to record 3 days worth of wages expense. And then the other question that came up, Brian, I would say 4 to 5 emails this weekend. The other question that came up was the subsequent payment of that payroll. What do you do then when those 5 days are paid? And what you do is you get rid of that payable and you record the expense that happens in the next year with the credit to cash for all 5 days. You guys saw that on a homework question if you started the chapter 3 homework. So I remember that being a little sticking point on the test. So there's that subsequent payment. That's an example of what I'm talking about. So in this case, it looked like there were 3 days in one period and then 7 days in the next. This must have been a bi-weekly payroll. So how do you get doing good at that? You keep practicing. You keep going through exercises where you see that subsequent payments are covered until you feel comfortable with it. And that's why you guys have all of that ungraded practice. Sometimes you don't see it on Connect because Connect usually shows you the assignments in the order that they're due. But if you click on your Connect assignment and you scroll down to the bottom, you'll see that optional ungraded practice. I would go in and practice problems that you know you're going to see on the test. And the review sheet I'm going to give you that I develop after I make the test today is going to give you a little bit of insight into that. I'll have that for you when you come back to class on Wednesday. Questions? Okay, accrued revenues are revenues that you earn, but that the cash hasn't been received yet. Biggest example on that is interest, right? So I was just helping a friend of mine. She's a recent widower and she has a CD and there's interest that she has accrued on that certificate of deposit, but because it only pays interest once a year, she doesn't see it in her checking account yet. So I was trying to explain to her, yes, it's not there yet. They pay it once a year, but you are incurring it as you go. That's an example of an accrued revenue. For those of you that did the team project, the lawn mowing business, I'll be grading those later today. That had an example of an accrued revenue. Jack had mowed the lawns, but he hadn't yet received the money from the client. So he had to put that accounts receivable on the books. That's an example of an accrued revenue. And then there's also subsequent receipts. That was a little sticking point on the homework as well. What happens when you get all that revenue later or all that cash later? Well, some of it's already been recorded, so you take that off, but you put the remaining revenue back on in the new fiscal year. Those are called future cash receipts. I do remember a couple multiple choice questions on that. Let me stop for a second. Any questions so far? It's a good review of what we did last time. This slide just shows how these are linked, how all 4 of these adjustments here in the adjustment column are linked. I think this is your book, this new version of the book has what they call a cheat sheet in the very back of the chapter. I think that's where this comes from. It shows you the vocabulary, it shows you the adjusting entry and how to classify it, and it shows you what happens on the financial statements. It would be a good slide to go over. You could write down exhibit 3-12 if you wanted to. We've seen this. We're going to do one of these today. This is a modified worksheet that helps us pull together all the adjustment data. We're going to do a problem like this today because I want to review the financial statements with you. I'm pretty sure that you guys will be creating a set of financial statements as part of your 10-point problem. So we'll review that today. There is, again, another great exhibit that shows you how the financial statements are created. We will only be doing those 3 basic financial statements. I won't ask you about the statement of cash flow. So that might be an exhibit for you to go look at as you study and prepare for this upcoming test. Today, we're going to refresh our memories on how to do the closing process. We know why closing entries are needed. We know they happen on the last day of the fiscal year. We know there's 4 adjustments, and these are the easy closing entries. These are the ones that you learned before all those weird contra accounts came into play last semester. So we're going to reset. The author used the words reset. We're going to wipe out the revenues. Then we're going to wipe out the expenses. Then we're going to wipe out the income summary and transfer the profit to retained earnings. And then we'll wipe out the dividends account, which is the equivalent of drawing for the sole proprietor. We're going to do an example of that today. We remember why we close because there's some temporary accounts that need to reset to 0. That's a good slide that shows you the difference. And once we close out the accounts, all we have left are what your author calls these permanent accounts. So if we were to do a post-closing, which means after closing trial balance, all we would see would be the asset accounts because those are permanent, the liability accounts because those are permanent, and the new equity accounts that we've learned about. There are 2, common stock and retained earnings. Retained earnings will have been adjusted for the net income or loss and for the dividends. We're going to practice that today. That's what's coming. And I just mentioned how to do those. We'll demonstrate those and get our hands dirty today in a moment. There's that shortened post-closing trial balance. The reason it's so short is because there are no revenues and expenses on it. They've been wiped out. Everything's been closed out to retained earnings. And so we'll take a look at that today. There's a great slide in there on the accounting cycle from start to finish. It's so small that you really can't see it on a PowerPoint. That exhibit is in the book. Here's what I would ask myself. I'm not going to ask you what's step 3 of the accounting cycle or what's step 4. I won't ask you that, but I do expect you to know that you have to journalize before you post. And that the reason we post is to get those updated general ledger accounts, and that we do financial statements prior to closing. So I would expect you to know the basic order that things happen in the accounting cycle. And then here's that classified balance sheet. It's not new. You learned it toward the end of last semester. I would expect you to know by now that assets are classified into one of 2 categories. Either current, if it's going to be used up or realized within 1 year, or long-term. Here they kind of throw in something they haven't talked about too much yet. That's in another chapter. But plant assets, you're used to seeing that. Those are those assets, property, plant, and equipment that have more than 1 year's worth of life. And what I wanted to point out to you again, GAAP says you have to show 3 things, whether it's on the face of the balance sheet or in a note. You got to show the cost, you got to show the accumulated depreciation and the resulting book value. So again, if that's not in your vocabulary, that word book value, let's get it into your notes. I think all we have left are a couple ratios. Yep, and we're done. So profit margin, you've heard me speak about, even if the author didn't ask us in some of the exercises and problems, we've been really good about calculating profit margins, which answers the question, how much net income does a company have with relation to its sales? And most investors want to see profit margins in the 15 to 20% at a minimum. So that's what we hope to see. On this screen right here are 2 very large companies in this country, Visa and MasterCard. you can see what their profit margins are. This also has to do with the pandemic. 2 years ago, it was 36%. A year ago, they were 50% and 53%. Visa is a Dow company, and so it is a widely held public stock. You can see how profitable these credit card companies are for a number of reasons. Okay, for outrageous interest rates that they charge those of us that don't pay off our balances, but more so as more and more people use their credit cards, there's that 3%, around 3% transaction fee. Every time a credit card swipe, there's a 3% transaction fee that the seller of the goods will incur. So during the pandemic, when there wasn't a whole lot of cash floating around, people had increased use of credit cards, and we see those profit margins of those companies going up, 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 up. And then finally, the last one, the current ratio. This is not new either. This is a liquidity measurement. Let me go back one because I remember a test question. Profit margin, that is a profit measure, an efficiency measure. But this second one, this current ratio, this is a liquidity measure. And liquidity helps measure, does the company have enough financial wherewithal to pay their debts as they come due? And the reason we saw a lot of small companies, well, large ones too for that matter, but small companies die out in the pandemic is they didn't have enough liquidity. They didn't have enough savings saved up to manage this long-term pandemic that we found ourselves in the midst of. I mentioned to you, my favorite restaurant is gone. One of my little favorite boutique stores to go in and buy gifts and clothing is gone. And so a lot of these mom and pop businesses that didn't have enough savings saved up found themselves facing liquidity issues. They weren't able to pay their debt, and many of them declared bankruptcy and are still declaring bankruptcy. So that current ratio, banks like to see 2 to 1. It does vary widely by industry. They do have Costco up. Costco can get away with those low current ratios because of vendor financing agreements that pay them electronically in a very short amount of time. Their current ratios are fairly low. Questions. That's a good review of where we've been. We used up about 20 minutes of time, but I think it's time well spent. For the rest of today, we're going to jump in, get our hands dirty. And what our focus is going to be is what you saw in that agenda. Let me go back to that real quick. We're going to take a look at the journal entries one more time. We're going to take a look at the effect on the financial statements. We'll spend one problem, it's our major problem, doing the financial statements after some adjustments. That'll take care of 2 and 3. The problem also helps pull it all together. It's a problem, so it's more intense than just the exercises. And we got the last few exercises are those 2 ratios that we just mentioned. I can't remember if they involve real life companies or not. Some of the best practice for this is to go calculate these ratios on some of the companies that you see that you're interested in. I haven't had a Starbucks in 2 weeks. I think I'm going through withdrawals. I think it's been 2 weeks. I hope to have one today. If I were doing ratios for publicly held companies, I'd probably be looking up Starbucks today because that's on my mind. Home Depot's stock was up a ton today. I might be looking up Home Depot's ratios to see what all the fuss is about. That's the way we learn. It's called academic curiosity. And if we learn something in a class that we're talking about, and you ask yourself, how does this apply to a real life company? That's how we become good investors. We start looking these things up as we learn about them. Let me stop for a second. Any questions on what's ahead as I put our schedule back up here? Or on anything we've mentioned so far? And Julie, you're keeping an eye on that chat room because I can't see it. Okay. Thank you. Okay, let's go take a look at the Excel files that I'm hoping you downloaded today. I'm going to go start those now. 3.9 and 3.10, you might be saying to yourself, wow, this is repetitive. We've done this before. It's because the adjusting entries are a lot of points on this next test. So I want to make sure that you're prepared for a 10-point test question where you're asked to do the journal entry. I want to make sure that you're prepared for the terminology part of it on can you classify this adjustment? And then we're going to take a look at, are you prepared on how it affects the accounting equation? So 3.9 and 3.10 are related. So the first thing we're going to do is we're going to come in here and we're going to actually do the adjustments. And then we'll go ahead and classify the adjustments. That'll get us ready for the classification part of this. And then we'll go back and we'll say, okay, how does this affect the accounting equation? Okay, so you guys have these Excel files in the modules link. I'm hoping you're in the habit now of downloading them by the time that class begins. And I'm going to start off by listing the letter. We're going to list the adjustment. Then we'll go back and we'll ask ourselves, how did this affect the accounting equation? Okay, so wages. Wages are earned but not paid. That affected wages expense. I think your book probably uses the salaries expense. Let me go check before I give you. Same thing, it's just a different way of terminology. Let me go see what they do so I can be consistent. Give me 1 second.
Professor, it says right there on the top, wages expense right there.
Thank you, thank you, thank you. Read the question. Wages expense, and if we look at that little chart of accounts, that will be wages payable, I'm sure. Yes, thanks, Samir, for the heads up. Okay, so all of us should feel pretty comfortable with actually doing the adjustment. That was for 8,000. I won't mess with the descriptions on these in the interest of time. I have some other things that I want to spend our time on today. But one thing I will ask you as we go through these, in hopes that you're starting to familiarize yourself with the terminology, I will ask you to classify this. Okay, I'm going to put that in red too. Every single adjustment is going to fall into one of 4 categories. So I'll list the 4, and then you guys can be anticipating what those multiple choice questions are going to look like. It's either an accrued revenue, an accrued expense, a deferred revenue, or a deferred expense. So I would encourage you to first ask yourself this question: has the cash changed hands? The answer is no. The cash has not changed hands because it's owed. So if the cash has not yet changed hands, it's an accrual. And in this case, it's an accrued expense. So I'm going to use that definition similar to what we did last week. Okay, shortly, we'll go put each one of these under the accounting equation, and we'll see what a kind of an effect it has on that accounting equation. That's what starts these critical thinking skills. Letter B talks about depreciation of 18,000. So on that one, we're going to debit depreciation expense, and we'll credit that contra asset account called accumulated depreciation for the amount they gave us. You guys should be prepared to compute it as well as we've done in a previous one. And I'm going to classify that, because I want you to get in the habit of classifying it. That's a deferred expense. The assets sitting on the books, we're deferring, recognizing it over time as the asset is used up. That's an example of a deferred expense. Letter C. They're going to make us calculate it. It said supplies had a debit balance of 240. They bought 5,200 during the year. And then he goes back and forth. So you're going to have to read on the test. They show 440 of supplies available. Okay, well, probably a little T account would be a good way to take a look at that. I think you guys are pretty good at T accounts by now. Let me write one up here. It said the supplies had a 240 debit balance at the start of the year. It says they bought 5,200. And when they took an inventory, they had $440 of supplies on hand. So you got to figure out how much has been used up. And when I do that, let's see, 5440 minus 440, I get 5,000 as the amount used up. So you will debit supplies expense and credit supplies. We've been doing a lot of those lately, so that you should feel pretty comfortable with that. And then the last thing I'm going to ask you to do is to classify it. We have 4 choices. This is an example of a deferred expense. Assets sitting on the books, they've been paid for, they've been there all year. You're deferring recognizing the expense until the supplies have been used up. It's always a deferred expense. Questions on that? Or on the first 3? Any questions on the first 3? Okay. Got to watch the prepaids. He'll go back and forth. Sometimes he tells us how much has expired, and sometimes he'll tell us how much is left unexpired. So you got to watch it. In all of these adjustments, we're looking for the amount used up. So for letter D, as I read it, I see that he's going to try and get a little tricky again. He tells us that at the beginning of time, of whatever this period is, this prepaid account had $4,000 sitting in it. He also said that there was $1,200 left. The word he uses is unexpired. You got to watch him. He's going to go back and forth. And so what we need is how much has been used up. And when we do that math in our head, we got 2,800 has been used up. So what we're going to do then is use up the insurance expense, and we'll reduce the asset down to what it is worth now, prepaid insurance, 2,800. I'm going to ask you to do one more step because I know what's ahead on the test. You're going to classify that. You got 4 choices. So ask yourself this, narrow your choices down to 50-50. Has the cash changed hands? The answer is yes. It's sitting in a prepaid account. If the cash has changed hands, it's a deferral. In this case, it's a deferred expense. Letter E. Unless you guys have any questions on A through D. Letter E would be the most missed if I were to ask this on a test, so I would watch this one. It is the one that students struggle with the most. It says the company has earned, but not recorded. Okay, hint, no cash has changed hands. They've earned, but not recorded, 1,050 of interest revenue for the year ended. Okay, in other words, that example I used of the widow friend has a CD. It's been earning interest, but the bank is not going to pay them except for once a year. Okay, GAAP doesn't care when the cash is received. GAAP cares about when the revenue was earned. It says the company has earned 1,050 of interest revenue. We need to put that on the books. In this case, they gave us an account called interest receivable, and we'll use interest revenue to record the revenue in. They gave it to us. They could have made us calculate it because we did learn to do that in Accounting 100. We use that principal times rate times time calculation, but they gave it to us. There's the adjustment. I'm going to have you classify it, even though your book's not asking. I know what's ahead, so we're practicing for the test. Ask yourself, narrow your choices down to 50-50. Has the cash changed hands? The answer is no. How do I know that? It said it has not been recorded. The cash has not changed hands. So this is an example of an accrued revenue. The cash has not changed hands, so we know it's an accrual. This puts revenue on the books when it's earned as part of the matching principle or the revenue recognition principle, that principle we looked at on the PowerPoint. And letter F, most of us can more relate to letter F because we owe interest. We are the ones with loans. We're students. Felt like when I was a student, I owed everybody. It says the company has a bank loan and has incurred interest expense. This is the flip side. This is the person who owes interest. That's most of us, most likely. So we need to put the interest expense on the books. And because we're not paying it right now, we may be paying it next month. That's interest payable. Has the cash changed hands? The answer is no. The cash has not changed hands. We owe it. And so we've just narrowed down our choices. This is an accrual. And in this case, it's an accrued expense. Let me stop because this is like, we went through it fairly fast because we've been working on adjustments. This is our second class day. This is more of a refresher of where we've been before we jump in and take a look at some new items today. So any questions on letters A through F on any of those adjustments? Okay, well, the next question is related, so I'm going to go read it with you. 3-10 says, go back and look at those adjusting entries in 3-9 and show the effect on the accounting equation. I think to keep this on the same screen, I'm going to go copy this and put it right next to what we did. So I'm going to hit the copy button. You guys can leave it down there. I just don't want to change screens and drive you guys crazy. I'm going to go paste that accounting equation up here. And that way we can keep everything on the same screen. So what we're doing right here is we're doing exercise 3-10. And we're going to go through and we're going to classify each one of these into the accounting equation. And so what you want to ask yourself, for example, let me do this first one as an example. Let me put it in yellow. On that yellow adjustment, what effect did that have on the accounting equation? Okay, well, wages expense goes under the equity umbrella. And when we incur an expense, it pulls equity down. So equity would have decreased by 8,000. And our liabilities, because wages payable is a liability, our liability would have increased by 8,000. At all times, remember, this is an equation here. At all times, you want to make sure that the left-hand side equals the right-hand side. I would write that out in an equation form on a multiple choice question to make sure I had a good understanding. We have 0 on the right-hand side and 0 on the left-hand side. They have to equal out. I couldn't have put this 8,000 over here under assets because then it would be out of balance. 8,000 doesn't equal a negative 8,000. So my hint to you is when you're answering these analytical questions about the accounting equation, write it out and then make sure whatever your answer is balances out that accounting equation, kind of like a scale of justice. The left-hand side has to equal the right-hand side. Okay, this second one, depreciation. Okay, well, once again, all expenses bring the equity umbrella down. And that accumulated depreciation brings the assets down because it was a contra asset account. Again, make sure the left-hand side equals the right-hand side every single time. Okay, that supplies adjustment. Once again, the expense brings the equity umbrella down. And the supplies is an asset. That adjustment brought the asset supplies down. The left has to equal the right every single time. Double check that when you do those multiple choice questions. Letter D was the insurance expense. Again, we have another expense pulling our equity umbrella down. This is letter D. And the prepaid insurance is also an asset. I'm going to move these down so they're more alongside the question that we're looking at. Here come the accruals. Interest receivable is an asset that pulls the assets up when we put the amount of interest that's owed to us on our books. And interest revenue, any kind of revenue, is going to pull the equity umbrella up. Make sure the left equals the right every single time. And letter F is that accrued expense. Expenses always pull the equity umbrella down, and interest payable is a liability account. So that would go under the liability section. That liability would be pulled up. We still got 0 on the left, 0 on the right. We know our accounting equation's in balance. And there may be a question that asks you, they'll give you a set of transactions, maybe 3 transactions, and they'll ask you, what's the effect on total assets, right? I wish the author would have asked us that question here. What's the effect of those adjustments on the total assets? Okay, well, real quick, using the magic of Excel, let me put some total lines down here. And those adjustments affected our assets, once I add these up, to the tune of $24,750. Had we not made these adjustments, our adjustments would have been too high because these adjustments pulled our assets down by $24,750. And with the liabilities, let me just pull this equation over. That's the magic of Excel. There's the effect on our liabilities. Had we not recorded those adjustments, our liabilities would have been understated by $10,500. And then most importantly, probably is this last number, which I'm going to put in blue. This is why adjustments are critically important for companies. Had they forgotten those adjustments or they not made those adjustments, their net income would be overstated by $35,000. Okay, why? Because the net effect of those adjustments is pulling that equity umbrella down by $35,250. So I wanted to do at least one exercise where we took all those adjustments, those mechanical adjustments, and pulled it back down to the most basic fundamental accounting equation that we're going to be using in this class. Everything goes back to this fundamental accounting equation. Sometimes the toughest questions for me, even at this stage of my career, where I've taken some very advanced classes, sometimes the most challenging part is answering that question, what's the effect on the bottom line? And with complicated transactions, this is what I go back to. I put a basic accounting equation across my desk and I take a look at the effect that each one had, and I can answer those brain teaser questions. That's a pretty good review of what we covered last time, carried back down to the most basic fundamental accounting equation that we'll be working with. So then I told you that we'd be working on one longer problem in class today. This is 3-3B. So I'm going to skip 3-13 and 14 because it's repetitive. So I will be skipping the demonstration on this one in class. It's very similar to what we just did. It's there to give you extra practice. And we're going to go on to the major problem in this chapter. Again, if you guys were in a physical classroom, I'd put you into groups and we would have a little group competition. And I would give you this problem and I would tell you to complete the worksheet and do a set of financial statements after the adjustments are made. And we would be looking at before and after differences, kind of like that Jack's lawn mowing, but this is a little bit trickier. It has more stuff going on. So let's read. We'll do this together, at least part of it. It said, following is the unadjusted trial balance. This institute provides one-on-one training who pays tuition directly to the business, and they offer extension training to groups off-site, like at the group's location. They give us a trial balance. Okay, so let's take a look at it. My eyes on a trial balance go immediately to the bottom. It does balance. And so I made you guys a worksheet on the next tab, and our goal is to record these adjustments. More importantly, I want to make sure that you can do a set of financial statements, because I'm going to be creating your test after class. I'm anticipating making you do a set of financial statements for 10 points. So that's why I wanted to at least demonstrate the new one, the statement of retained earnings, if I have time. Okay, so what I did to make the presentation easier, I gave you guys a worksheet and I snipped the information from the previous problem so that we didn't have to flip back and forth. So questions on where we're headed. Here's what I'm after, and then I'll take your questions. We're going to put the adjustments in. We're going to use Excel to foot this across. And then most importantly for this problem today, our focus was on adjustments last time. Our focus today is, can you do a set of financial statements? Because that's a 10-point test question. And then would you recall how to do those 4 closing entries that we studied in accounting? In 2 separate chapters, we studied closing entries. This is a review of that. So let me stop and take your questions. Okay, not having any questions or hearing any questions, then let's try this. I put a worksheet up here. Somebody asked me or emailed me this weekend. They said, hey, I noticed the worksheet was in the appendix. Do we have to know how to do a worksheet? And my answer to that question was, you already know how to do a worksheet, so it's nothing new. So the appendix is there. I don't think I asked you guys to do a worksheet on the test, but I would expect you to know how to do one. All right, so letter A, an analysis of the Institute's insurance policy shows that 9,500 has expired. Okay, go find the prepaid here. They're talking about this. Let me make it in color so you can see it. They want the adjustment. Remember, he goes back and forth. He says in letter A here, he tells us how much has expired. So what we're going to do is I'm going to drop a little letter A there. And I'm going to drop in the amount that has expired, which was 9,500. Let me make this bigger so you can see it. If you guys want to make it bigger with me, here's this select all button. It's the one right above cell A1. It has like a half triangle. Click it. I'm going to go make all of these 20. It looks like it's already been set, but let me try it again. That helps. So we would credit prepaid insurance, we would debit insurance expense for the 9,500. I'm not going to do it on this one, but I would expect you guys, as you're doing homework, go ahead and classify each one of those. So that's letter A. Questions on that? Okay, let's go ahead and read B then. Back up or on the next tab, whichever is easiest. And inventory, keyword. They're telling you how much is left. And they're telling you that teaching supplies are available. So I'm going to go find teaching supplies right here. I'll put it in a different color so we can talk about it. It's in orange. They're telling you this time how much is left. They're making you figure out how much has been used up. Well, if there's 70,000 right now in the books and you should have 20,000, that means they used up 50,000, the difference. So we would credit that teaching supplies asset account. We go find supplies expense on here and we would go debit that for $50,000. Again, in your head, you should be classifying these as well. Let's keep going then. If I don't hear any questions, speak up if you do have them. Letters C and D are depreciation. First one's equipment, second one is the library. They didn't make us calculate it, they just outright gave it to us. Let's do equipment first, 5,000. Okay, depreciation expense on equipment. And we would use the accumulated depreciation account on the equipment. And then we'll go do the library. That was for a different amount. 24,000, I believe. I'll go back and check that.
I think it's 2,400, Professor.
Thank you, Thamir, for catching that. That's why I need to go check it. And accumulated depreciation. Thank you very much. I am going to go check it now that Thamir brought that up, just to make sure. Yep. And then I'll wait for you guys to get caught up until I go on to letter E, because I do remember letter E giving us some trouble in class last semester. Any questions on those first four? And glancing at those first four, I think those are all deferrals. Those are all deferred expenses so far. All right, let's go pay attention to letter E here. I'm going to make it a little bit bigger. It says on November 1st, okay, stop. What's the date of this worksheet? 12/31. Okay, so it says on November 1st, the Institute agreed to do a special 2-month training course starting immediately for a client. The contract calls for a $14,300 monthly fee, and the client paid the 2 months training fees in advance. Okay, stop. The money was received ahead of when it's earned. If we go look at the unearned revenue account, based on what they just said, we should see 2 months of fees sitting in there. So let's go look at that unearned account together. Here it is, right here. Let me make it in a different color so we can talk about it. That blue number represents 2 months of training that they've already done, but the company paid this institute ahead of time. So it's sitting there in a liability account, and our job is to figure out how much of it has been earned. November is gone and December is gone. So both months have now been earned. How are we going to make the adjustment? We're going to debit this liability account for $28,600 to get it out of the unearned account. And we'll go credit some type of regular old revenue account. So when you go look at your regular old revenue accounts, it looks like that was training fees. That's the best choice, I think, of accounts. So what did we just do? We took it out of the liability account that it went into because the money was received ahead of when it was earned. We took it out of there. So now we got nothing left in the liability account, and all of it is now on the income statement. Why did we do that? Because of the revenue recognition principle. We have now earned the revenue. The recognition is now complete. That's a deferred revenue. Why? The cash has changed hands. We got it ahead of when we taught. Kind of like Cerritos right now. If you guys pay tuition, they don't get your tuition at the tail end. They get it up front before you take the class. That sits in an unearned account until the time is passed where they earn it. Questions on E? All right. F, also through the class last year. E and F were the ones, the two most confusing ones on here. Okay, F says on October 15th, remember this worksheet stated 12/31. Okay, on October 15th, the Institute agreed to teach a 4-month class starting immediately to an executive with payment due at the end of the class. Okay, so they've done the teaching, but they haven't yet received anything for it. The revenue recognition principle says you record revenue when it's earned. We've done the teaching, we've earned the revenue, we need to put this on the books. They give you the amount, so we're going to stick it into accounts receivable because it's money that's owed to us, and then we'll put it in the tuition revenue account. Okay, so let me go do that. This is like Jack mowing lawns, but he hadn't yet collected the amounts. That's what this is the equivalent of. So for letter F, we will debit it for $59.50. I believe that was the amount. Let me go check. $57.50. Sorry about that. $57.50. And we will put that in the regular old tuition revenue down here. If we were to classify that, that would be an accrued revenue because the cash has not changed hands. We haven't received any cash yet. All companies go to their cutoff date and they ask themselves, have we put all the revenues that we've earned on the books? We talked about doing cutoff tests for those of you that are going to go into CPA work. Let's go back over here. We have G and H left. G says they have one employee that is paid weekly. As of the end of the year, 3 days salaries have accrued at the rate of $150 per day. Okay, this is one of those where they make you figure out, okay, how much do we need to put on the books? 3 days. In other words, if their payroll's on a Friday, this would be a Wednesday. There's 3 days of salaries that have accrued. So 150 times 3 is going to be $450. That's going to go to some kind of an expense account. Salaries expense, it looks like. And that would go also to a payable. Let's go look at the payables and see what our choices are. Looks like we have salaries payable here. That's an accrued expense because no cash has changed hands. And the last one, if I go back up, last one says the balance in the prepaid rent account represents rent for December. Okay, well, now that it's December 31st, that time has passed. It has no more value. So I'm going to go up here to this prepaid rent account. Let me put it in green. And what they told us is that $3,800 is for the month of December. So our last transaction is going to be to bring that prepaid down to 0. And we'll go put that in the rent expense. $3,800. So the reason that I like this problem is more practice with accruals and deferrals. But I want to make sure you guys can do a set of financial statements. And so I'm going to use this to demonstrate the financial statements. My next step, especially knowing that I transpose numbers, I'm going to add these column totals up from the top to the bottom to make sure that my debits equal my credits. So let me carry that across just to be on the safe side, because we wouldn't want to go any further if our debits didn't equal our credits. By the way, that reminds me, I sent you guys an announcement this morning. I have a few rare spots open, doesn't happen too often, on the Excel class. It's the perfect companion with this class because a lot of what we're doing follows along with this 101 book. It's a cheap class. When I say that, the book is $20 about used. And there is no access code because I've created the materials. I would strongly encourage you to consider taking it. It starts a week from today, except the week from today is a holiday. So it'll start on Tuesday next week. If anybody wants to preview the class, you can send me an email and I'll be happy to send you a syllabus and the schedule that we're following. I also sent you guys a short video. It's a great class. It's probably one of my favorite ones to teach, because we learn how to do some things financially for ourselves. We learn how to compare loans. We learn how much quicker we could pay our cars off and the interest savings. These, I'm just talking from projects that we do. We learn to use all kinds of equals if formulas. We learn about pivot tables, which are critical in the workplace. We learn to research stocks. We also learn to research mutual funds. And we learn how much we can retire on if we start saving in our 20s versus in our 50s. And so if anyone wants more information, make sure you let me know. Usually that class is filled to capacity by now, but I did notice, I think I had 6 or 7 spots left. So I wanted to give you guys first dibs before I have the department chair send out a big announcement to everybody. Okay, not hearing any questions then, let me get rid of this adjustment data that I put up there, because we're going to foot this across. We're going to let Excel foot it if we need to. So the reason that we do this adjusted trial balance now is to, again, make sure our debits and credits are equal. And then we're going to be asked to do 3 financial statements. You guys know how to do an income statement. So I will probably jump down to the statement of retained earnings, since that's the new one, in the interest of time. But we noticed that cash didn't change, so we're going to bring it over, right? I hope you guys heard me say in an earlier lecture, adjustments rarely involve cash. Okay, the only time they would involve cash is if there's a bank reconciliation that's done and there's errors noted. And accounts receivable went up by $57.50, we'll carry it over. And teaching supplies are now $20,000, which matches what they told us were on hand. Prepaid insurance, I can't do that in my head, so I'm going to do 19,000 minus 9,500. And I got 9,500 left. The prepaid rent has been used up. The professional library still costs 12,000. GAP says you have to maintain that cost number, but it has been accumulating depreciation. So now if we look at those contra accounts and add them up, that's 4,900. The equipment still has a cost of 40,000. We'll carry that over. And accumulated depreciation was increased for that year's worth of depreciation. It's now sitting at 25,000. Accounts payable didn't change. Salaries payable is now sitting at 450. The unearned fees account has nothing in it because it's now been used up, or it's all been recorded as regular revenue now. I'm going to highlight these new accounts because they are new. So I want you guys to pay particular attention to the new stuff in these past couple of chapters. So we still have 11,000 invested by our owners through common stock. We still have 60,500. By the way, retained earnings does not typically change during the year until year end. There could be some things that happen that we'll learn about in chapter 11 to change it, but most of the time, retained earnings is not changed until year end. Dividends didn't change. That was the amount they paid their shareholders in order to share the profits. We have a whole chapter on that coming up. Now we're back over here to the income statement accounts. We have 2 revenue accounts that went up. I'm going to let Excel do the math. Same thing on the second revenue account. I'll let Excel do the math. And the rest of these are expenses. So we're going to be carefully going through, make sure that you add properly. 2,400 is the depreciation expense for the year on the library. 5,000 on the equipment. The salaries expense got adjusted upward. The insurance expense got adjusted upward. The rent expense got adjusted upward for that last month of rent that had expired. Our supplies got a huge adjustment to it, 50,000. And our advertising didn't change. And our utility expense didn't change. And with all those debits and credits flying around, let's make sure that they equal, especially again with my propensity to transpose numbers. Hopefully Julie, maybe Thamir, someone is looking at me carefully to catch any of those. And we do balance, that's a good sign. Okay, so we covered most of the adjustments, not all, but most in this problem. The reason that I wanted to demonstrate it is because I want to demonstrate two things on here. How to do the financial statements, at least the statement of retained earnings, because that's the new one. And then I want to talk about closing entries. While we have this up here, we might as well have a review of closing entries as part of our lecture today. So I'm going to stop. I've been talking for a long time. There was quite a bit of work involved in that problem. Anything you see there that you're not quite sure about, remember, Julie will be posting the files into the discussion area in case you want to go at a slower pace and do them at your own pace. That's why she puts them there.
I have a question, Professor.
Sure.
Is a worksheet really used in like the real world? I mean, just because there's so many different like accounts that go into each of these broader accounts, how is that kind of like utilized? Is that all taken into account, like all the individual like subsidiary accounts like accounted for it in the worksheet?
A lot of times a worksheet's used just to pull together all the data, but more often than used in financial statement creation, Thamir, to be honest with you, this is used more in what if scenarios, right? So if we're looking at this worksheet and a company is deciding, wow, what if we could get 40% more students in next year? What would that do to our revenue? So they'll go in and they'll make an adjustment to increase the revenue by the 40,000, and they'll put a receivable just for the time being or cash on the books to give a what if projection. So more often these days, I see it used more in a projection or in a pro forma format where they're projecting out. Many times in budgeting too, with these what if scenarios, a worksheet type format will be used as well. Yeah, but the purpose of it is to pull together all the data in one place and project out to the owner what his or her financial statements are going to look like prior to actually doing them. Good question. Professor. Yeah, great question. All right, so what I want to get into your notes are these three financial statements. You know how to do 2 out of the 3 already, but I want to get some facts into your notes. The income statement is the first one that we do. And an income statement shows whether a company was profitable or not. And for the service-oriented businesses that we're working on so far, it is literally the revenues listed out, the expenses listed out, and there can only be one of 2 results, either a net income or a net loss. Sometimes, although not proper, you will see the word profit used instead of net income. You may hear this. In fact, QuickBooks still does refer to it. You'll hear older accountants refer to this as a P&L. That stands for profit and loss. They're talking about the income statement, but that old P&L still carries forward. I hear it used a lot today. Because we're pretty good at doing income statements, I'm going to do a quick and dirty one here where we'll calculate the net income only because we need it for the statement of retained earnings. And then I'll pull over what a properly prepared income statement would look like, and hopefully somebody can take a screenshot. And Julie, if you can't get the screenshot in, let me know and I'll send that to you. But looking at our adjusted trial balance, here's our revenues right here. There's two of them. That would be the two revenue accounts. So my quick and dirty is going to be, I'm going to go sum up those two accounts. I'm going to come back here and my revenues would be the sum of, I'm going to click them, that cell, click, plus the cell below it. There's my revenues. It would be the sum of those two revenue accounts. And my expenses would be the sum of all those expense accounts that we saw. I'm going to go quick and dirty, add them up using Excel. And that's what I get. So my net income, just so I can demonstrate the statement of retained earnings to you, when I take the difference between those two, I got 54,200. Okay, now I'm going to pull over the actual income statement because you will be doing this on your homework and I don't want to hear, well, you didn't demonstrate this in class. Okay, I don't have time to do everything sometimes. I want to focus on the newer stuff. So let me go pull that down. I'm looking over here on my other screen. Just give me 30 seconds to find it. All right, I'm going to bring over my income statement and hopefully someone can snap a picture of it. Give me 1 second to get it on the screen. 1 minute. Okay. There's that income statement. If someone can take a snapshot and maybe post it in the chat, that would be awesome. We knew it was going to be 54,200. Okay, we did a quick and dirty on this off to the side of the worksheet. And Julie, if for some reason you can't get the snapshot, just text me and I'll make sure I post that behind your solution. The one I want to demonstrate is the new one. Okay, the statement of retained earnings, because some of you may have never done a statement of retained earnings yet. So I will demonstrate that. I do expect you to be able to create one from scratch. So I'm going to start off with the who, what, when. This is Alonzo Institute. This is a statement of retained earnings. And you have to define the period. This is for the year ended. And I'll center that quickly. Those of you that are wondering, how do I do that so fast? It just comes with practice on using Excel. I would strongly encourage you guys, you don't have to take the class I'm teaching, but you got to become Excel proficient, because when you reach your universities, I can tell you for a fact, your teachers will all be using Excel. They'll give you projects using lots of formulas in Excel. And if you haven't spent the time learning the Excel program and you don't feel really comfortable with it, you're going to sink. And I don't want to see anybody sink. All right, so here's what it looks like. It's going to show the change to retained earnings. So the first line item is always the retained earnings from last year. Sometimes you'll see this December 31st of the previous year. Sometimes you'll see it January 1st of this current year. So your author has gone back to showing you last year's balance. So that's why it's dated December 31st. Let me put prior year so you realize that that would be from the previous year. Like that. Okay, that comes off the worksheet. It doesn't change during the year. So I'm going to come over here and I'm going to look for retained earnings. And it was 60,500. That would have been carried over from prior year. Just like the statement of owner's equity from last semester, increased this for net income and decreased it for net loss. Same thing here. It's very much similar to a statement of owner's equity. So we're going to add in our net income for the year. And we just computed that. Your author does this all in one column. Okay, I would have split it out in two, but he uses one column. Let me fix that alignment right there. And then he subtotals it, which is different than what I would have done, but trying to follow along with how he's teaching you. And then just like last semester, your drawing made the capital go down. This semester, the equivalent, which is dividends, makes the retained earnings go down. So I'm going to take out those dividends that they paid, and we would have to go find that. It looks like it's 20,000 right here. So let me go put that in there. Now that's interesting. Typo, brand new book. I see a typo. They show dividends of 50,000. You guys double check me. I only saw 20,000. And that would give you ending retained earnings of this year would be the difference between those two. Okay, that's obviously not right. 017. That looks better. Double underline, show the user that you're done. Any questions on that?
Yes, Professor, I have a question. Are dividends like they're taken, like say you have a net loss, and are dividends contingent on you having retained earnings to begin with?
So legally, a company needs to have, before their board of directors declares dividends, they need to have sufficient cash to cover it. However, there are companies that suffer losses that, because of their history, they still pay dividends out, like Boeing has suffered losses, but ever since the first airplane took off, Boeing has regularly paid dividends. So as long as there's sufficient cash to cover the dividend, that's what's needed. And the board of directors would have to declare it before it becomes a legal obligation.
Okay, thank you.
Yeah, so dividends is usually a sharing of profits. So I think the mirror where you might be coming from is what happens when a company has a loss? Well, two things. They could either pass on a dividend for that year, which would totally upset the shareholders, or they could choose to share their rainy day fund, you know, the money that they've kept aside for such emergencies, and pay a dividend out anyways. As long as there's sufficient cash to cover it, it would be legal. That's the one I wanted to go over with you. That is new. Okay, dollar signs belong on the first line in each column. So they would go here and always at the bottom. And then the third statement, which I would hope that you could do, is a classified balance sheet. I think this one only asks you for a regular balance sheet, but I would encourage you to learn that classified balance sheet because we covered it toward the end of Accounting 100. Your author just does a regular old balance sheet. Remember why we do a balance sheet. I want to get that into your notes also. A balance sheet is done last to prove the accounting equation. So what it shows is that assets equals liabilities plus equity. And so you'll see your assets listed. The thing I want to point out to you is, remember that new requirement on the plant assets. You got to show three things. I hope this gets into your notes. You got to show the cost, the accumulated depreciation, and the resulting book value. So one more time, rather than taking the time to do it, I'm going to pull over the answer. And if someone can do a screenshot, maybe capture it in the chat room, great. And Julie will somehow get it into her notes. If not, I'll follow her notes with this. Let me pull it up for a second. There is the balance sheet. I wanted to go over a couple of the logistics with you. Assets are listed in order of liquidity, how quickly they can be converted to cash. So cash is always first, and 95% of the time receivables come next. Okay, so you see that happen here. Here's those 3 items that are mandatory disclosures, either on the face of the balance sheet or in the notes: the cost, the accumulated depreciation, and the resulting book value. Couple liabilities down here. The other thing I want to point out that I'm going to put in yellow just for presentation purposes, you're used to seeing one equity account from Accounting 100. It was called capital. Now you're going to see 2 accounts in the equity section. The reason there's 2 accounts is because there's 2 types of equity. The common stock is the invested equity that came in from the shareholders. That's the account we used when the owner created the company or when additional investments came in. The retained earnings, on the other hand, is earned equity. That's money that the company has generated and retained or kept inside. When a company earns money, they have 2 choices. They can retain it, keep it for that rainy day that we talked about, or they can distribute it out to the shareholders in the form of dividends. We have a whole chapter. The hardest chapter in the whole book is on that little teeny equity section. It's how to do the equity transactions. It's comes near the end of the semester when we're all tired. And so we'll have a whole chapter on those equity transactions. And of course, the reason that we do this is to show that assets equals liability plus equity. And you always want to make sure that those balance. What I would encourage you guys to do, it might even be a discussion post. I can't remember with 6 classes who's doing what, but there may be a discussion post that has you look up some real live balance sheets or some real live income statements on companies that we see every day. I'm amazed when I do those discussion posts. I'm amazed how much I learn from others in the class looking at companies that I never would have thought about. So we're all going to learn from each other at some point. That's the way it should be. Questions on that? Okay. Then I think I'll go to the next one, exercise 3-20, to demonstrate the closing entries. So on your next one, I just want to make sure that you guys remember how to do closing entries. There are 4 of them. Okay, so I want to get that in your notes. There are 4. We do closing entries 1 time on the last day of the fiscal year. And to be honest with you, most companies have accounting software where you push a button and it's done. But because we're learning the accounting cycle, I do expect you guys to understand how the data flows. And so I would expect you to be able to answer multiple choice questions. I'm honestly thinking about taking a 10-point test question out of the test on closing entries. I'm trying to move this over so you can see it. So here they are to get them into your notes. Step 1, you're going to close out the revenues. Step 2, you covered this in 2 different chapters last year. You're going to close out the expenses. Step 3 is we swept those into what I refer to as a junk drawer called income summary. So we're going to close out the income summary, but here's the new part. We're going to close it not into capital like we did last year, but into retained earnings. Because what that does is it transfers the net income or the net loss to the retained earnings account. And out of the 4 steps, that 3rd one is usually the most missed. And the 4th step, where we wiped out withdrawals last year, This year, we're going to close out the dividends because that's what's taken the place of withdrawals. So 4 closing entries done on the last day of the year. The purpose is to reset, I think is the word your book uses, to reset the nominal or temporary accounts. What the heck does that mean? Temporary accounts start over with 0, right? It's like you and I all get a W-2 for any work that we perform. My employer is Cerritos College. I get a W-2, which shows my salary through 12/31, and then we all get a clean slate the next year. That's because they wipe out salaries expense. And now on January 1st, it starts over at 0, and then we all accumulate our wages and it just keeps on being wiped out at the end of the year. All right, so in this example here that they gave us, there is 1 revenue account to close out. If you had me for Accounting 100, you heard me refer to closing as a game of opposites. You do the opposite. So that first journal entry to wipe out those revenues would be a debit to do the opposite, a debit to services revenue in this case for $44,000 and a credit to that income summary account. Let me make some few adjustments on these column widths so I can get it neatly on there. Income summary, we learned about it last year. I refer to it as a junk drawer that you clean out once a year. And so it's a nominal or a temporary account. And I'll leave a description for your notes. That first adjustment is to close out the revenues. That would be closing journal entry number 1, CJE, closing journal entry. The second closing journal entry would be to wipe out the expenses. Closing journal entry number 2. Closing's a game of opposites. Since all these expenses have debits and my goal is to wipe them out to get them down to 0, we would credit each one of those individual expenses. But since we know that rules of journalizing say you got to list the debit first, I'll go ahead and I'll list that debit. I'll put a blank or I'll put an orange line, and then I'll go through one by one to each one of those expense accounts and wipe them out. So depreciation expense would be wiped out by doing the opposite, by crediting it for $3,000. And salaries expense would be wiped out by doing the opposite, by crediting it for $22,000. And insurance expense will be wiped out by doing the opposite, $2,500. And rent expense and supplies expense, both of those would be wiped out. Make sure you understand that we're not wiping out the asset account supplies. We're wiping out the expense, the part that has been used up. So the rent was $3,400, the supplies was $2,200, and then my income summary would be the sum of the things in the junk drawer. There it is in our case. Questions on the first 2 steps before we go to the trickier 3rd step? Just ask away. Okay, 3rd step, I'm going to come over to the other side to keep it on the same screen. What I tell students to do, because again, I know that there's things around the corner that you can't quite see, make a T account for income summary. If you make a T account, you'll never miss this, because right now there's a lot of companies out there that have losses. Losses up until now weren't as common. Right now there's lots of losses. If a company suffers a net loss, this entry is going to be flipped or backwards. If you make a T account, you'll never miss it. Okay, so here's the junk drawer, income summary. I had 1 credit right here for $44,000. Let me put color on it so you can see where it comes from. It's that yellow number. That was from closing the revenues, or another way of saying it, that was closing journal entry number 1. That's where the yellow one came from. Closing journal entry number 2, we debited the junk drawer. We debited it for 33,100. Let me put that down. Okay, so this one came from here. This one came from here. What we did there is we were closing the expenses. Another way of saying that, that was closing journal entry number 2. I'll make that bigger so it shows up. Okay, now foot the account. If you foot it, you're going to be less likely to miss it. So when I foot this account, in this case, not all cases, but in this case, I have a credit balance. That credit balance is reflective of my net income. How do I know that? That was the revenues less the expenses, and the revenues were higher. So the purpose of this third closing entry is to wipe that out. How do we wipe it out? Last year used capital, but we don't have capital anymore. So we're going to sweep that into our retained earnings. So I'm visually staring at this number and it has a credit balance. So to wipe it out, I'm going to debit the income summary, and I'm staring at it, 10,900. Okay, I'll make it green so you can see where it came from. And we're now going to sweep it into retained earnings. And now my junk drawer is all closed out. In fact, I think it would be wise, because I do remember a multiple choice question, I think it would be a wise move here to keep a T account for retained earnings, because you very well may be asked a critical thinking question on what retained earnings would be after closing. Okay, well, let's see if they gave us a beginning balance. I need to go up here and check. They did. They said retained earnings was 37,600 to begin with. I'll put beginning balance. And what we just did with that journal entry, we just increased retained earnings by the amount of net income. Right now, you're going to see a lot of companies flipping that journal entry because they have losses, and those losses would be charged to retained earnings over here. So we wiped out the revenues. That was step 1. We wiped out the expenses. That was step 2. We wiped out the income summary. And what that journal entry did was we transferred the net income out of the junk drawer income summary and put it into retained earnings. And then the last step, remember there's 4. The last step would be to close out any dividends. Last year it was drawing. This year it was replaced by dividends. And so let's go up and see what our dividends were. Here it is. It's a $7,000 debit balance, just like drawing with a contra equity. It has a debit balance. We need to wipe it out, but the junk drawer is closed. So we don't put in the junk drawer, we charge it to retained earnings. So since dividends has a debit balance, I got to do the opposite. I'm going to credit dividends. I'm going to debit retained earnings. And the amount was 7,000, I believe. Okay, so this does 2 things. This is new to you. To wipe out the dividends. And transfers it to retained earnings. So if I do that, there's a high possibility that a question may ask you, what would the retained earnings balance be after closing? Well, we could foot this. This is like a little miniature statement of retained earnings if you think about it now, right? Because what's on a statement of retained earnings? You start with the beginning balance, you add in the net income, and you take out, instead of drawing, let's call this dividends. That would be a better word now. And let's foot it. I'm going to sum up this side, and I'm going to take out the other side. And when I do that, whoa, I don't know what all three of those are for. That's odd. Let's try that one more time. I don't know why that showed up in three places. Sum up these three and subtract out that one. Let's try that. 41,500. Is that a good year? Right now, anytime a company can increase their retained earnings, that would be considered a good year. And the last thing this problem would ask you for is a post-closing trial balance. I want that in your vocabulary. So let me go write it down and I'll just pull it over. A post-closing, it's like post-war era. It means after closing. Post-war era history is after the war. Post-closing means after closing. What would that look like? It would only list assets, liabilities. I want you to think about this because this is missed on the test. What equity accounts would it list? Two things. Common stock will be on there. And that ending retained earnings that we just computed will be shown on there as well after closing. So I'm going to bring that over and hopefully someone can take a snip or a snapshot of that. Here's that post-closing trial balance. You'll see how short it is. Any questions on that?
Yes, Professor. So the whole closing process, could you also say that that the whole process is just like a translation into the journal of what you did in the financial statements? And also my second question would be, is the post-closing trial balance like what the same accounts you would see on the classified balance sheet?
Yes, so a couple of things. The journal is an economic history of what happened. There are no balances in the journal. I think what you meant to say is, would it be a copy of the ledger? Would be a copy of the ledger accounts after the closing process is a fair statement. And yes, these would be the numbers from the last year's balance sheet because we don't have retained earnings any, I'm sorry, we don't have any more revenues and we don't have any more expenses. And our equity account now is after we've closed out everything. So this is going to look really similar to the last balance sheet that they create, except it's just one line for each item.
Thank you.
You are welcome. Anybody else have any questions? Because all we have left are a couple ratios that are repeating ratios. You've learned them prior. And then I really need you guys to work hard on acing this test. And when I say acing, I mean doing really, really well, because a lot of these first three chapters are review of things you've practiced for a whole semester. So we got to invest the time and really score well, because I keep mentioning to you that the hardest part of this class is the last three chapters. And so I want to build up your insurance points right now. I want you to score really high when the stuff is a review, to leave yourself some wiggle room when the material gets progressively harder. By the time we get to that equity section, it's going to get pretty difficult. All right, the last two things that we're going to be talking about are the profit margin and the current ratio. So before class started, I just went and copied these numbers, and I'm looking right now to make sure I copied them all correctly. If any of you guys see a transposition, let me know. But profit margin is one of the most heavily quoted margins out there. I have never invested in a stock without knowing whether the company's profitable. And some of you that know some of my investing history might say, well, you invested in Tesla when it wasn't profitable. That's because I knew it was on the horizon with all the reading that I do. So profit margins, we look for stable profit margins. We look for stability. We compare them. Right now, there's a big push with Lowe's. Lowe's has been slowly increasing market share. So Lowe's stock price went way up here a little bit ago because their profit margins are climbing and they're taking market share away from Home Depot right now. I just watched a blog this weekend on Lowe's. So if I were interested in Lowe's stock, it's on my watch list right now. One of the things I would be interested is, have they been able to create solid profit margins? And if I saw them going higher and higher and higher every year, that would be a good sign as an investor. So what you need to know on the test is, how do you calculate it? And what I told my 100 students, it's the last line of the income statement divided by the first line, right? The last line's profit. The first chunk is the sales that the company's had. So all we're going to do in Excel is we're going to divide them. You guys can watch me divide them. I'm going to press equals and I'm going to go click on the net income number. It should be in the same cell. And then I'm going to do the divisor sign, which is the slash. It's right next to the shift key. And then I'll go click the sales number. And when I do that, I will get a percentage. Okay, what does that mean? For every $100 in sales, this company has about $9.80 in profit. Okay, is that good? I'm not sure what industry they're in. But I know that if that were Lowe's profit margin, I'd be comparing it to Home Depot and Ace and some other hardware stores to answer the question, is that good, or are their competitors doing better than them? Okay, well, in Excel, once you copy one formula like that, I can just drag it down for the others to get the answers into your notes. So this is what we call a regular active cell. It's that fat cross. When I move it to the corner, it turns into that skinny black cross. That's what we call the fill handle. So let me show you one more time. Fat white cross is an active cell. I move it to the corner, it turns into that black skinny cross. Drag it or click it and drag it down. And we'll get all the percentages in there. You can go back and delete the lines that don't have anything on it. So knowing no other information about the company, if the author asks you what is the most profitable, it would be this company right here. That's a very high margin. That company profits almost half of what it brings in sales. The lowest profitable company is 4.5%. Okay, you would compare them. You could compare them intra-company, which means you can go see what they've made over the past 3 years, or you could compare them to competitors in the same industry. You know, if Lowe's is up and coming and the market's showing that business is moving away from Home Depot into Lowe's, that might be something that I consider buying on after I do a whole bunch more research. But that's what the profit margin shows. Questions on that? If I had time right now, and I don't because I've kept you guys quite a while, but if I had time right now, I'd go pull up Home Depot and Lowe's, and I'd go, just for the heck of it, go calculate each one's profit margins and compare them. That's how you learn. You go outside of what we do in class on some companies that you're interested in. Last one. This is not new. This is the current ratio. The current ratio, unlike the first one we just did, which is a profitability measure, this is a liquidity measure. So I would get that word into your notes. Let me write it down here. This is a liquidity measure. Does a company have enough financial ability to pay their bills as they come due? Why are investors concerned about that? If they don't have enough bills to pay, if they don't have enough money to pay their bills as they come due, they're not going to be around years from now, and your stock investment might lose value. Not only that, if they can't even pay their own creditors, there's not going to be any money to share with you in terms of dividends. All right, I'm not sure. Do you guys recognize these as real life companies? I recognize Edison because that's what we have. I'm not familiar with these other companies, so I'm not sure if these are actual companies or not, but we're going to do the same thing. You need to know the formula. I wrote it down for you right here. Current assets divided by current liabilities. So I'm going to do the same thing I did before. I'm going to do equals, and I'm going to go grab the current assets, and I'll press that divisor sign, that slash sign, which is right next to the shift key. And then I'll click on their current liabilities. And when we turn that into a ratio, the way you read this is one number to another number. So in this case, we got 247. Let me tell you what that means on that first one. For every dollar in current debt, Edison has $2.47 in current assets with which to pay it off. That's what that means. Banks like to see 2 to 1. Other companies that we saw in a previous, like Costco, can get by on slimmer items because they're constantly paying their vendors electronically very shortly after they get the merchandise. So in the interest of time, I'm going to do the same thing I did before, but instead of dragging it down, I'm going to drag it across. So active cell is a fat white cross. Move it to the corner, turns into a skinny black cross. That's the fill handle. It also works going across. So the way you read those is something 2-1. So who's in the best position, who has the strongest current ratio? That would be Edison. It's the only one that's above 2. And before, I bet Amir's probably thinking this because he has a very analytical mind. Before someone asks, you can have too high of a current ratio, right? If I had a ratio of like 10 to 1, let's say, and we know that banks like to see 2 to 1, I would probably be better off putting that money into some type of an investment, more of a long-term investment that's going to earn me some money, rather than just keeping it in a cash account, which is paying barely anything in terms of interest. So you can have a current ratio that's too high. That is the chapter. Again, probably 90% review with the little tweaks for the new equity accounts that we've been learning about. Does anybody have any questions on chapter 3? Anything they've learned, or maybe homework they've started this weekend that confused them? Anybody? Okay, let's finish the chapter 3 homework if we can before Wednesday. It's not officially due until Sunday, but let's see if we can finish it before Wednesday. That way you guys can come back and ask me any questions. Julie did post the 2 files in the chat area. So if you're live in class, you guys might want to download those right now. I think that was Julie, yes, that posted them. And then everybody else, I will hold a test review session on Wednesday. My plan at that time is to give you a better overview of the test. I'll be able to tell you exactly what types of problems you can expect. You guys can come in and ask any questions. And my guess is it may be a short class day, but if you guys have questions or things that you want explained or more practice, email me and tell me what you would like to do. If you have any suggestions, email me and tell me what you'd like to see covered during that test review. Otherwise, I'll probably share my outline on how I would study for this test. We'll go over some practice exercises and problems. And then again, I mentioned this at the start of class, I will not physically see you guys next week because Monday is a holiday and Wednesday is your proctored exam. We don't come into class on test days. Okay, not hearing any questions. I will end class. Of course, those of you that are taking the class remotely or online and you guys are watching this later, you'll still get your questions answered. Just make sure that you guys use Julie as a reference, especially knowing we have a test coming up. I'd look at Julie's hours this week. You can drop in Zoom with her. I'm in my office live before class, every class session, and on your off days too, Monday through Thursday, I'm in my office. Then you guys have those instructor tutorials. There's 3 of them where you can go to a live instructor and get help with your homework. So there's plenty of opportunities out there. There is a holiday weekend coming up. So don't get yourself don't be last minute and don't get yourself into a bind where you're stuck on something and emailing people, you know, Monday night at 11 o'clock is not going to work. So I'm open for suggestions. Anything you guys would like to have covered on Wednesday, I'm happy to do that. Email me with your suggestions if you don't have anything for me right now.
I have maybe a suggestion, Professor.
Sure.
Do you think maybe you could take a look at the ungraded practice problems and maybe like give us an estimate of what problems may come on the test just to be sure?
I can, Thamir, but the reason that I hesitate to do that, I will in this first test, the reason I hesitate to do that is we need to be studying concepts and not problems. Right.
Okay.
So for example, if I say that you guys need to be able to calculate missing equity, and I say, here's an example on such and such a problem, and then people freak out if it's asking the same thing, but it's worded different, or there was a number here that I didn't understand there. It's like some people get so absorbed in memorizing the computation instead of the larger concept. I kind of hesitate to do that, but on an introductory test like this where most stuff is a review, I can probably go take a look at that and give you some suggestions. Yes.
Okay, thank you so much, Professor.
You're welcome. Anybody else have any suggestions they want to bring up? Or do you feel kind of iffy on anything in the first 3 chapters and you'd like to review that concept? If you think of one, email me, but it'd be best to email me today because I'm going to create the test shortly and I want to make sure that I include your input on our review sheet for next time. So do it shortly if you can. Thanks for coming in, guys. See you later.